Did you know you could unlock tax-free cash from your properties without ever selling them? Refinancing isn't just about lowering your mortgage rate. It's a powerful wealth-building tool that most investors aren't fully using. So welcome to Strategy Saturday. I'm Charles Carillo, and today we're discussing maximizing wealth through property refinancing strategies. And whether you're looking to boost your cash flow, fund renovations, or invest in new properties, refinancing is the key to unlocking the equity hidden in your real estate investments. But here's the thing. How do you know when refinancing is the best decision? Can you really use the BRRRR strategy to scale your portfolio? What's the risk of over-leveraging your properties during a market dip? In this episode, I'll answer these questions and break down 4 powerful refinancing strategies that top investors use to grow their wealth. So stick around. This could change your thoughts about property investing forever. Refinancing is a powerful, tax-free real estate investment strategy that allows investors to unlock valuable equity within their property. Now, there are a few reasons why a property owner would refinance investment property. Number 1 is rate and term refinancing. So investors are able to save money by refinancing to a lower interest rate. When you reduce your debt servicing, it will increase your cash flow. This allows investors the ability to pay down their loan faster, add additional money to the reserve fund, or invest elsewhere. Now, the caveat here is to verify that what you will save on interest justifies the fees associated with refinancing. Number 2 is cash out refinancing. So investors are able to withdraw equity from their property by replacing their current mortgage, if any, with a higher balanced one. Now, this is typical with investors who have owned a property for a while and possibly their loan term is ending and they need to refinance or sell. And when they refinance, however, the property has gone up in value, so they're now able to extract some cash during the refinancing without over-leveraging the property. For example, an investor bought an apartment complex 10 years ago for $500,000 and obtained a $400,000 mortgage, and it had a 10-year term. So 10 years later, the property, let's say, is worth $800,000 and the mortgage has a balance of $350,000. So when the investor refinances, they obtain a mortgage for $500,000. After paying off the original loan of $350,000, they take out the $150,000 tax-free because it's not income. You're borrowing, it's a loan. And the bank has no issue since the new loan to value is only 62%. So it's very safe for them. The investor gets that $150,000 out tax-free, and the previous lender is happy because they got paid off in full. Now, the investor can now use the $150,000 for performing renovations or investing in another property. Number 3 is the BRRRR strategy. So the BRRRR strategy stands for buy, rehab, rent, refinance, and repeat. And the strategy has gained popularity over the last few years and works best with investors that are actually buying distressed properties and adding a lot of value. That's the whole key there. This is because the whole strategy hinges on the refinance aspect, and you cannot refinance and extract your original cash from the deal if not enough value was created. So for example, you purchase a property for $100,000, most likely financing it with a short-term hard money loan, and invest $35,000 into the property, including all the financing and closing costs. You rent the property and contact a local bank to refinance it. The bank will give you a 70% loan to value on the refinance. Since the property is now worth $200,000, they will lend you $140,000. So now you're able to pay off the hard money lender, recoup your construction funds, pocket the $505,000 while still owning the property that is hopefully cash flowing. Now the strategy continues as you repeat and keep recycling cash. Now, a couple possible drawbacks could be that the completed deals will usually not cash flow that much since you're max leveraging them, but you will still have a property with a renter that's probably covering most, if not all, of the expenses. Now, one bad deal can pause this investment strategy, or if there's a dip in the market, lenders might tighten their lending guidelines, offering a lower loan to value, which will make refinancing and extraction of your original upfront capital not possible at that time. Now, the main benefit here is not quick upfront cash, but the wealth building that occurs when you buy and hold investment properties for years, because what you're doing is you're using the sweat equity that you're putting into the deals for long-term wealth building. Number 4 is portfolio refinancing. So for investors with multiple properties, refinancing with a portfolio loan usually allows investors to obtain better loan terms and a lower rate. Now, many lenders will shy away from small loans, but when you have several properties that are valued, say, over $1 million collectively, more lenders are now interested in making the loan. Borrowers are able to obtain a better lower rate and a portfolio loan versus a number of individual loans. So they're paying one loan at the end of the month. Now, portfolio loans are cross-collateralization. This is where it gets risky. One bad property can bring down the rest of the properties. Now, this is exactly what happened to a mentor of mine. He had many properties in a portfolio loan, and when he started having issues during 2008, 2009, the bad properties brought down the good properties since they were all under one umbrella. Investors that integrate refinancing into their investment strategies are able to harness the property's equity in order to achieve more favorable financing. And they're able to perform property renovations or obtain the cash required to invest in another property. Of course, when you increase your debt, it increases your risk. So it's always important to not over-leverage your properties when refinancing them. If you're interested in learning how to prepare your property for refinancing, you can check out episode SS157. That is SS157. I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then.
Have you always wanted to invest in real estate but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.